No matter your age, your plan for retirement can start today. From the News Channel 5 network, this is the Retirement Report.
Good morning. Welcome to the Retirement Report. I'm Hank Parrott, your host. All right, this has been an exciting week, hasn't it, on Wall Street, seeing what's going on with the GameStop and AMC and some of the other, and learning all kinds of things, right, about the trading and how the new terms like short squeeze and learning about options. Maybe for most of you, this might be more than you want to know. Or you may be a little confused by it. Here's some things that I want to share, mainly because, of course, what I'm dealing with has to do with your nest egg. My clients and for myself, for that matter, investing is different than what's going on, what's been in the news, which is speculating, which basically is another term for gambling. Okay, gambling and investing are two different things. Speculating and investing are two different things. Okay. Speculating is when you're maybe taking a bet. Okay, maybe you have a hobby account. In other words, a small account that you're investing in such a way with that you're looking to hit a home run or play around and enjoy these kinds of for some it's entertainment and they enjoy it. However, okay, just making sure to say the obvious maybe is that we'd never want to bet in these types of trades more than we're willing to lose. Okay, so whoever you are at whatever level, all right, just making sure of that. All right, this is good common sense type of advice. We don't want to bet. We don't want to speculate with more than we're willing to lose. And this is one of those areas where I have clients that have hobby accounts and enjoy that type of activity, much like any other leisure activity in a sense. And think about it, when you go on vacation, if you go to an amusement park, if you go gambling, maybe to a casino even, always setting those limits of this is how much we've budgeted for this activity. We're not going to exceed that budget. Okay, that's just again being good stewards of our money and making sure that we protect our nest egg it's going to be there when we want it, need that income in retirement. Now some commentary on this a little bit. When Robinhood stopped trading yesterday, this is one of the areas, this is going to create a lot of issues. There's going to be some investigations in this. I'm sure we've heard in the news, of course, all these, the Treasury Secretary and the SEC and everybody's watching and there'll be more to be seen on this. One of those that I think they'll see is there'll be some players behind the scenes that, when I say behind the scenes, there'll be some players maybe driving this thing that may benefit more than others. And were they driving a narrative? The part about grouping together, that's certainly, and driving trades is another area that you would not normally do. Certainly in the business of finance, we can't all start some kind of little club and say, okay, everybody, all these financial advisors or all the investment advisors out there, get all your clients to buy this one stock, and we're going to because we're manipulating the market is a big no-no. That will get you in trouble. So I don't know if that appears to be at least potential here. According to Dave Portnoy at Barstool Sports, one of the things he sees is that Robinhood, by their actions yesterday in ceasing sales, may have in fact bailed out the hedge funds, giving them, with that big drop, giving them an opportunity to get out of those trades. And that, again, could create some additional, issues as far as the SEC goes. There's some other things that go into this. There's potentials for conflict. There's potential for, again, for illegal activities. We're going to see how that all shakes out. Concerns are more from my standpoint. Those types of trades and what's going on there is one thing. How it might affect the greater market is a bigger thing, and how what that might look like. This is one of those areas where there was a recent interview with Steve Grantham, and he's a value investor. And one of the things he talks about gets into the concerns about bubbles. And he's not alone in this. There are a lot of concerns right now about bubbles in the market, in particular with tech. There's some things that reminiscent of, in fact, what happened back in 2000 when we had the NASDAQ bubble burst. If there is, I mean, you look at valuations of the market, you look at the fact that everybody's getting kind of excited about pumping more money in. This type of euphoria is usually a sign that things could get a little dicey as far as certainly we're seeing a lot more volatility. The VIX is an example of that. This is the volatility index on the S&P options, and we're seeing that those are at above what we would normally want to see as far as levels above 30, for instance. That's indicating higher volatility, big swings in the market, and big swings in the market can also be indicative of the potential for a bear market. So these are all concerns that we're having, that I have right now, is more about that. And what I want to stress to you then is, again, defensive strategies. Having built in, I talk about modern portfolio theory all the time, as you know, and one of the things we talk about that you want to glean from that is the fact that you have to have defensive mechanisms in place, ways to protect yourself against bear markets. Now, what might that look like? A very simple one is the most and basic and most important one to start with is asset allocation. As I've said many times, asset allocation is the biggest determinant, and there's tons of research on this. Okay, we have basically 50 years of Nobel Prize winning academic research supporting this, that asset allocation, what you have in your portfolio in the form of stocks and bonds to start with, the mix of stocks and bonds is one way, but you have to dig down deeper. It's also what stocks and what bonds, right? But that's where you start. Asset allocation is the biggest determinant of what you're going to get for returns in the market and what type of risk or volatility you're going to be subject to in the market. Okay, so the more, if you're heavily weighted right now in large cap stocks, as an example, the S&P right now has outperformed, the growth end of things has outperformed value many times over the last 10 years, so 11 years at this point. So what we're seeing since March of 09, the bull market run that we had with the little hiccup we had last spring, one of the things that we're seeing with this, okay, is that we've had this large run, or this big run, I should say, of large caps, and we haven't seen small caps keep up, and we haven't seen value keep up. Now, the reason that's important to note is that typically these things run in ways that you can have a run like that, but then there's going to be an offsetting run typically. These things come back to that average, that mean, over time. And when we see what's happened, and we had the S&P up 13% a year, okay, on average, over the last 10 years, now we've got to be thinking, well, what's the next 10 years going to look like? All right? Because if you look at the last 20 years, now you have an average of closer to about between 5 and 6%, as opposed to 13, about half, or less than half even, what the market has done over the last 10. This is very important in terms of positioning yourself, and I would say that urgency is getting greater than ever, because there are a lot of people out there that believe that we are seeing more and more the potential for a bear market. And with some of the policies that are going on right now, when you think of what's going on in the economy, okay, and we've got the administration making moves now that have reduced jobs even further at a time when we've already trying to recover and get more jobs. We don't need to create less jobs. Even with even if it's altruistic in saying that this is going to create more jobs in the future, then let's get through a period of a pandemic and the effect that it's had on our economy first. Okay, that's not to get into political commentary, but more to say that the common sense piece of this is, for us, if you have fewer people in the workforce, that means fewer people paying taxes. That's, you need more debt. That's the potential for printing more money, devaluing the dollar, inflation, and of course, again, getting into the potentials for recessions and bear markets and bubbles being created. We're going to talk about that more. First, we're going to take a break, and then we're also going to get into today, by the way, taxes. This is tax season's upon us, so we're going to get into helping you prepare for getting those taxes done, and maybe some tips on how to reduce taxes as well as minimize them for the future, and more, of course, on the market. But first, a break. Join me here. We'll be right back on the Retirement Report.